About financial conditions, which worries you more? Warnings that rising short-term rates are bringing the yield curve closer to inversion, or the fact that long rates have risen very slowly and in fact are nearly 20 basis points below their recent high? How do you account for the fact that long rates have been so slow to rise, and what does it say about the inflation outlook as well?
So let me briefly mention the yield curve. I mean, it's the yield curve, something that people are talking about a lot, including FOMC participants, and you have a range of views. It's something we're going to continue to be talking about. But it's only one of many things, of course, that we talk about. I think that discussion is really about what is appropriate policy, and how do we think about policy as we approach the neutral rate? How do we understand what the neutral rate is? How do we know where it is, and what are the consequences of being above or below it? That's really what, when people are talking about the slope of the yield curve, that's really what they're talking about. We know why the yield curve is flattening. It's because we're raising the federal funds rate. It makes all the sense in the world that the short end would come up. I think you asked the harder question is what's happening with long rates. And there are many things that move long rates around. Of course, there's an embedded expectation of the path of short rates. There's the term premium, which has been very low by historical standards. And so arguments are made that a flatter yield curve has less of a signal embedded in it. In addition, I think what you saw most recently that you referred to, Steve, was just risk on, risk off. In a risk off environment, people want to own U.S. Treasuries, and you see, Treasury prices go up, rates go down quite a lot. So, but I think ultimately, what we really care about is what's the appropriate stance of policy, and there may be a signal in that long-term rate about what is the neutral rate, and I think that's why people are paying attention to the yield curve.
Nancy Marshall-Genzer with Marketplace. Companies are buying back their shares at a record rate. Corporate debt is up. Consumer debt is rising. Are we in a credit bubble? Is that something that you're worried about?
So if you look at households, you do not see excess credit growth. You don't see high levels of credit going out. So not so much households. And that really was where the problems were before the financial crisis, was particularly among household borrowing, particularly around mortgages. If you take banks, then of course their leverage is significantly lower, or to say it differently, their capital is significantly higher. If you ask about non-financial corporates, that's really where leverage is at levels that are high relative to history, but defaults are low, interest rates are low. So that's something we're watching very carefully. But again, I don't think we see it as. I think there are a range of views on that, but we are watching non-financial corporates. Households are in good shape, though, and that is so important, because that's where we got into trouble before, and it's often around property and particularly housing where you see real problems emerge. We don't really see that now, so we take some solace from that.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.